on the banks, it'll make those depositors do a better job shopping for the right bank. That's kind of what I would call the old-fashioned hardline view. There's a more modern regulatory view, which is that, listen, the typical depositor, even a fairly sophisticated depositor like a small business or even a high net worth individual, they're not in a position to evaluate the balance sheet of these banks. How are they going to figure out if there's like toxic assets that are hidden on the balance sheet of these banks?
The regulators didn't see it with Silicon Valley Bank and a lot of these banks. So
you don't really get that much more moral hazard by putting the depositor on the hook for that. Remember, the management of the bank already is penalized severely by losing all of their stock.
So I'm trying to get to, before Chamath interrupted me, I'm trying to get to the bigger moral hazard picture here, which is
Jason.
Fuck you, before you interrupt me. But the point, eat your nuts for a second. The point I'm trying to get to is, should commercial real estate, should that be bailed out? How should society look at that next card that you are saying is going to tip over? How would you handle that piece? Should they? Okay,
well, let me just finish the thought on depositors. Yeah. So the modern regulatory view is that when you open a bank account, you shouldn't have to think about the bank's balance sheet. You just want it to be safe. You don't want all the brain damage. And look, I think there's a lot of merit to that argument. As it turns out, I mean, I've been trying to look into this. How much would it cost the system to just fully insure depositors? It turns out that we have about 17.5 trillion in deposits in the U.S., almost 18 trillion. And one of the misnomers you'll hear is, well, it would cost us 18 trillion to basically insure all the depositors. That's not true, because first of all, 10 trillion
people don't even
is
know.
Already insured under FDIC. Right. It's only about 7.5 to 8 trillion that's left.
Less than half is left. Okay.
That's right. Exactly. It's around 8 trillion. So
isn't it shocking the innumeracy of people that make these claims?
I know, it's
unbelievable.
crazy.
This is why All In Podcast is top 20 or top 10 in the world, because we're actually breaking down the numbers.
Right.
So continue.
By the way, the leading proponent of this theory that we should just basically not bail out, but backstop the deposits is Bill Ackman. And he's been making, I think, a pretty compelling case that if you don't protect deposits at small banks, all the money is going to flow to the top 4 banks. That's already in process. Why wouldn't you?
That's happening. Yeah, we're watching it happen.
Right. So I've been trying to figure out how much it would actually cost us to do that. And what I've realized is that it's not 18 trillion. It's 8 trillion. But by the way, that's the amount of deposits. That's not the risk premium. So if you look at FDIC at the end of last year, there was about 130 billion that had been paid in to the FDIC fund by premiums paid by these banks. So in other words, the insurance premium paid by banks was about 1.3%. So if you were to now additionally cover the whole thing, all the deposits, it would be another roughly 100 billion of premiums paid by these banks. That seems very manageable to me, actually. The question is the FDIC fund adequate? And I think we're about to find out. It may be the case that a 1.3% insurance premium grossly, understated the true risk of putting your deposit in a bank. And we're about to find out that the FDIC is inadequate. I don't know the answer to that question.
Well, I think this boils down to the profitability that an equity shareholder of a bank expects of them. And to your point, is it viable for large GSIBs to guarantee 100% of their deposits? Absolutely. The implication of that will be an enormous hit to their short-term profitability and their return on invested capital. It would just take a massive hit. And so as a result, the stocks of those banks would fall pretty precipitously, which would have a real negative impact on the executives and the CEOs of those banks and the shareholders that own those bank equities. So I think ultimately it'll come down to that decision, which is that if you do want to protect the depositor in the American banking system 100% for every dollar and do it in a simple way, it will come at the sake of the equity holders of the banks. And if you're willing to make that trade-off, then you can guarantee 100% of the deposits. If you do not want to make that trade-off, then the equity holders will still retain more value than they would otherwise.
And Freeberg, we've seen a couple of examples of the market, the free market, looking at the situation and making new products and services. Wealthfront, Mercury Bank, both talked about load balancing across 12 accounts, $3 million. So that would make some people who had over 250K just instantly be backstopped and insured. And then where, there's discussion of I talked about last week, hey, why don't you just have a vault where you pay a bank to hold your money safely? I got a ton of responses from All In fans pointing out multiple banks and services that have been trying to do this, and also crypto solutions. So is there going to be a free market solution, you think? Or when we're starting to see them emerge, that maybe covers this gap a little bit, Freeberg? And then what are your thoughts just generally on should we backstop the banks and the depositors, to be clear?
So if we just quickly analyze the function of a bank, they loan money to either residential real estate buyers like homeowners, or commercial real estate buyers, or businesses that need it. I think the majority of the capital goes to residential real estate. And if they can't loan enough money, they typically buy bonds, right? They buy other people's loans in the form of bond securities like treasuries or asset-backed securities or other things like that, or mortgage-backed securities. So they use the cash to make those investments, to make those loans, and then they obviously earn a return on that. I think we've talked about this in the past. The thing that Balaji, I think, has misstated, and it would be good to have a conversation with him about this publicly, because I have listened to some of his interviews in the last couple of days. He says the banks they don't have the money that you, the depositor, thinks that you have. And so what he's saying kind of implies that there is no money, that there is no asset value there at all. He uses Sam Bankman-Fried and FTX as an example, that the money that was given to Sam Bankman-Fried's exchange fund was used to buy assets that then very quickly declined in value by 99%, but he held them on the book at 100%, and then he reinvested the money in all sorts of other different stuff. And in the case of the loans made by banks and the assets that they as a result hold, the value may have dropped by 25% in kind of the worst case, which is, the Silicon Valley Bank 10-year treasury bond scenario, where they bought, all $20 billion worth of treasury bonds. And they took a big hit on that. But it doesn't mean that there's no asset value. It means that the value has declined. And typically there's a buffer between the asset value that the banks are meant to hold and the deposits that they owe back to their customers. And if that buffer gets exceeded, then the bank technically has negative equity. And if all the depositors said, I want my money back, and they went and sold those bonds into the market, they wouldn't be able to make the depositors whole. But it doesn't mean the depositors end up with zero. It means instead of getting 100 cents on the dollar, they get 93 cents on the dollar or 88 cents on the dollar. And it would require an orderly dissolution of the bank's assets, selling those bonds into the market to generate the cash to pay back the depositors. So the reason we've seen this Fed vertical spike number is because assets are moving so quickly. Depositors are moving their value so quickly from one bank to another that in order for the banks to make the